During the Great Depression, millions of Americans lost their life savings as thousands of banks failed. And our country learned the hard way that it is critical for the health of the economy for people to have a completely safe space to store their money. I grew up in Oklahoma, decades after the Great Depression, but I grew up in the shadow of always hearing the stories about who had lost money, who'd been wiped out, and what it meant to show up at your bank and the money that had been carefully saved had just disappeared. In 1933, Congress created the Federal Deposit Insurance Framework, and as the chairman said, depositors have not lost a penny of their insured deposits in the 92 years since then. FDIC and NCUA insurance is currently limited to $250,000. Above that, if a bank or credit union fails, customers with bigger deposits may have to wait in line and hope that they will be able to recover some portion of their funds. Now, small and mid-sized businesses need a safe place to store money for payroll, operating expenses, and everyday payments. They often maintain balances above $250,000 in their transaction accounts. Several recent bank failures have made clear that the deposit insurance framework could be strengthened to better serve small businesses and to level the playing field between banks on Wall Street and smaller banks that serve Main Street. Take a look at what happened in March of 2023. Silicon Valley Bank and Signature Bank blew up, creating the third and fourth largest bank failures in American history. In order to protect from additional bank runs and stop a full-blown financial crisis, the Fed, FDIC, and Treasury took the extraordinary step of guaranteeing all uninsured deposits at those banks. The government backstopped literally billions of dollars in deposits for massive corporations like the venture capital firm Sequoia, crypto company Circle, and electronics company Roku. And those companies did not lose a penny. Compare that with two small bank failures in Oklahoma and Texas in the years after SVB crashed. And the story turns out to be very different. Local small businesses like pharmacies and grocery stores and construction companies that kept cash at those community banks got $250,000 in FDIC coverage and collectively lost millions of dollars on the uninsured balance. I don't think we want or expect small businesses to comb through community bank call reports every quarter to see if it's safe to keep your transaction account there. I don't think they should be required to make an investigation to see if there might be executive fraud at the bank when deciding where to have a checking account. The last thing a small-time dentist or landscaping company or a bakery should have to worry about is losing money because their local bank failed. People understand which banks will and won't get bailed out if there's trouble. In the week following SVB's crash, $100 billion in deposits left the little banks, while the largest 25 banks saw $120 billion in new deposits. Drawing deposits out of smaller banks diverts funds away from local lending to families and small businesses and pushes it toward Wall Street speculation. And the small businesses without access to a mega bank, especially in rural communities, have no choice but to suffer the consequences if their local bank or credit union fails. Now, I've long pushed for leveling the playing field by increasing deposit insurance limits for business transaction accounts. Covering these accounts would reduce the likelihood of runs, help smaller financial institutions compete, and ensure small businesses have a completely safe place to store their cash. If small and mid-sized businesses are protected, this could also limit the government's impulse to backstop giant depositors when a crisis occurs. As the committee considers this legislation, there are a couple of principles I hope we will stick with. First, the deposit insurance limit for banks and credit unions should be raised to a level that covers the cash needs of small and medium-sized businesses, businesses that do not have the capacity to execute sophisticated cash management strategies deployed by massive corporations. Second, the increased limit should apply to transaction accounts, accounts that are used to make and receive payments. The account should not pay interest or other monetary rewards. And finally, the policy should be simple. Complex rulemaking, opt-in and opt-out features, convoluted definitions would create unnecessary compliance costs, customer confusion, and invite regulatory arbitrage. A clear and simple framework will be easier for the FDIC and NACUA to administer for small businesses, easier for small businesses to understand, and easier for banks to implement. This is a common sense policy with broad bipartisan support. It's good for small banks and credit unions. It's good for small businesses, and it's good for our economy.